What's up everybody, Tom here with another video. Today we'll be talking about the latest stock market news for the week ahead, including what you need to be looking out for this week, and our technical analysis thoughts on the S&P 500, Nasdaq, gold, volatility index, and US dollar. Last week's stories were all about the US dollar and of course a further slump in the markets. But with the election close at hand in November, we're going to now start seeing volatility into the debates and other election-based news. There's a lot to cover in this video, so stay tuned. So just to start this video, quick shout out to the trading community. Thank you so much for supporting the channel and getting us to 20,000. We'll be doing the live stream on Monday during the opening bell, and during that period we'll be drawing a lucky subscriber to win $520 to go towards their trading account. When we're talking about our weekly analysis, what are we doing? Well, we're trying to use a top-down technical analysis approach to go through the monthly, into the weekly, into the daily. And one of the things that we always want to do is rehash what happened last week to understand the market's momentum, sector rotation, and other things that are going on. So last week, in terms of Friday's trade, we saw a pretty strong day of trade coming off previous lows. So the market almost hit on the S&P 500, the 3200 zone. It hit 3200, 10 to 15 area. It pretty much reached exactly where we thought there would be buying momentum and buying pressure. And now we've seen it come back into the FANG stocks being Microsoft, Apple, Google, Facebook, and Amazon. When we select on the heat map though, what happened over the last week, things become a little bit different. So we actually had an increase in Microsoft, Apple, and Amazon, but a decrease in Google and barely flat on Facebook. So really across the board, if you actually look at the S&P 500, it's been weaker than the Nasdaq over the last week. Overall, almost every sector was down except for utilities and some of those FANG stocks and tech stocks that have been bought pretty heavily. And we expect this to probably continue unless the market makes a series of higher highs. And we'll talk about that in our technical analysis very soon. So what are we looking at for the week ahead? Well, Wall Street will be looking at, of course, Trump-Biden debates, and these could spark volatility. Last time in the election in 2016, we saw Mexican peso making big moves after the debate, as well as bonds and other things. This time should be very, very similar. And of course, the first debate will be on September 29th, 2020. So it'll be a date to watch for the US, of course, futures and the US stock market overall. Another thing that could be a bit of an X factor this time around is that in this election period, we may see tweets or Twitter becoming a thing that's going to stir volatility. So JP Morgan have of course said this, but we've seen it before where Trump has said certain things on Twitter and it's moved the markets between 1% to 2% quite quickly. Expect more of that volatility over the next month. Now let's get into the sentiment of what was happening over the last week and what we think is going to happen this week. And we can do that by going through the monthly charts down, of course, into the weekly and daily. We'll start on the weekly here for the dollar index, and it was clear that dollar was all on in terms of huge amounts of bullish momentum last week. Now, what is that telling us? Well, it's telling us that people are moving towards safe havens. They're looking at the US dollar and they believe that they're potentially dumping some sectors in the stock market, reducing their positioning ahead of the election and risks overall. We can also see that it broke through that 93.80 to 94 zone, which we called was a very key resistance. And on the weekly, notice this red exponential moving average. This is sitting right on where you would expect the market to find some form of resistance, the 95 area. Now we've mentioned the 95 area being resistance for the US dollar and the 96 area being resistance for the US dollar. And there are a few reasons for this. One, the 20 exponential moving average, and some previous, of course, support over here. But then if it got to the 96, we'd have a 200 simple moving average, the green line, and we'd have a 50 exponential moving average being the blue line, all sitting, acting as dynamic resistance, as well as previous support during the drop acting as resistance as well. So it's clear to think that the dollar index may have a little bit more strength in it for now, but that doesn't mean that it won't have a pullback before it finds further strength into the 95 or 96 zone. Now that we've moved past this market structure, really what it says is that the market will usually pull back after an aggressive move like this and will pull back to some form of moving average. So on the daily, we might see the 20 and the 50 meet each other, potentially that to act as support. And obviously there's going to be huge buying pressure off the 94 should the market get back this week to that zone. In terms of other things that we can be looking at is pullbacks to the 20 moving average on the 4 hour. For more aggressive pulls and runs into the 95 first resistance, we may see the market pull back to a 20 moving average and then of course bounce off that zone into the 95. So US dollar will certainly be worthwhile looking at this week. And if it continues advancing while the stock market remains kind of in a sideways market, that could be a precursor as well to further bearish momentum on the stock markets around the world. What about Dr. Copper, one of our favorite looks at how the market is performing from a recovery standpoint? Well, copper has found support and it bullish hammered on the Thursday close off the 50 exponential moving average. This is the daily chart. So the 50 exponential moving average held it twice. We talked about this in our previous video, and we talked about how this zone is pretty much a very key area. If we break lower for copper, that would probably also mean that the stock markets are moving back down to their lows, and we'd expect copper to not find support until 2.8. Now, if that was to happen, usually it would be around the same point that the stock markets would be moving lower. What we did see though was a buy up of copper and of course new highs reached on Friday, not with a strong close, but still a bullish close above the 50 exponential moving average. If copper remains above the 2.95, that's pretty healthy for the stock markets, and we don't really expect, of course, to see further new lows as copper is up at this point. Now, if copper falls under, we would expect new lows to be formed in the stock market. It's always one that's worthwhile watching during the week. Onto the volatility index, what have we been seeing there? Well, volatility index remains stuck between the 25-50 zone and of course body closing around this 29 to 30 zone. We spoke about how it needs to break this 31 zone to really open up the 35 to 38 area, and that's just the nature of the VIX. Basically, the volatility index or fear index, if it can't make new highs like it failed to do here, it often just sells off. And that's also in line with the stock market reaching a almost equal low on the S&P 500 and then of course rejecting that with strong buying pressure. So right now the VIX still remains in a very sideways kind of area. And if you go to a weekly, it becomes more clear that we haven't seen bullish close momentum in terms of fear into the weekend. One of the things we always say on this channel is that if we're seeing the market sell into the closes, that's a very bearish sign, and it will always be that way. The close is the key on the S&P 500 and the Nasdaq. And in this case, both Fridays, we've actually seen slight buying pressure for the last 2 weeks. Buying pressure into Fridays is generally relatively bullish for the market open on Mondays as well. Time will, of course, tell us whether that's true again. So before we go into the S&P 500 and Nasdaq analysis, let's just have a quick look here at gold. Gold is bounced off the weekly 20. It's pretty much hit its first zone of support. It's also in line with 1850. We know that gold likes its 50s and of course 100 zones. So it's bounced right off that area, just closed above on the weekly. If we go down to the daily, not much structure here other than we could be seeing a 20-50 cross between the red and of course the blue lines. If we break this level short, and I will say if we break this level short, it really activates gold to have further selling pressure, and I wouldn't be surprised to see it down at this 1760 to 1750 area, where it'll probably meet up with the 200 exponential moving average, this green line, and previous market structure. As you all know, one of the things that we look for on this channel is previous market structure. And it looks like previous market structure is mostly around that kind of 1750 area, with 1800 possibly acting as some support as well. Gold has been really one of those things. Every $50 is really the key when you're in uncharted pullback territory, as well as you want to draw Fibonacci's on these type of things to find out whether they're coming back 38.2 or a 50 fib. So if we draw the fib of the whole move, you'll see that we're just about to reach that 38.2, and somewhere in this zone between the 38.2 and the 50 fib, you usually expect the market to find stability, accumulate, and then hopefully move in the direction long. It's always a good area between the 38.2 and the 50 Fibonacci. Similar on silver, we saw on the weekly here, it closed just above, and that's pretty important. If we take a fib of the whole move, in terms of the move from March to now, which I think is very fair to do so, you'll notice that it hits the 38.2 fib, goes into around the 50 fib, and it's bounced off that area. Before we go into the smaller timeframes, another thing that we can note is there is some form of trend line off the bottom. We were talking about this during our live stream. Basically, if you take the lows and you kind of extrapolate them out over time, even go down to a daily chart, what you'll notice is that it was holding a trend line across this point and there was some bouncing there. Now, I use trend lines as more of an area that I'm interested in probably taking a look at, and then I'm interested in seeing the price action results from that point. So here we have silver, and we can see that it bounced or found a bullish hammer followed by no new high the next day. Now, one of the most important things about bullish hammers is we want to see follow through the next day. We want to see follow through in terms of the market. So I would be probably placing some form of alert just above to make sure that not only has the market respected this level, but it has made a new high above the previous kind of wick zone. Once it does that, it's showing you that the momentum is bullish and aggressive. So we've got a trend line here that's gone all the way from the March lows. We've got between the 38.2 and the 50 Fibonacci. And on top of that, we have bullish rejection candle. And then at that point, we'd have, of course, the confirmation that the momentum is bullish and aggressive. Where would it go? Probably somewhere into the 25, where it would meet maybe the 20 and the 50 exponential moving average, acting as dynamic resistance. But overall, it's all about seeing that kind of wick high above the previous wicks of the day when it did reject. We want to see follow through movement in the markets for silver. Let's now take a look at our S&P 500 and Nasdaq thoughts for the week. So S&P 500 bounced off the 20 exponential moving average, which we talked about, and almost hit that low of 3,200. So what we've always talked about is being rectangles. We want to draw ranges, and then when it comes into a range, we can buy that dip. Now, we actually got a double dip on the S&P 500 we'll be taking a look at, but whenever you're doing your weekly analysis, always check out the SPX and always make sure that we're looking at, of course, the main closed market. We don't want to necessarily be looking at the futures. If you go to a monthly chart, you'll see we actually made a new low in terms of wiped off everything that we put on in August, and we went down to just around that 3,200, which was previous market peaks before the crisis. If we take a fib of the whole move, we're still not even into the full territory of pullbacks, where we've only hit really a 23.6 and not even a 38.2 fib of the move. So I think the election is really going to be the fundamental underpinning of whether the market goes up or down right now. For now, though, we've got the bullish hammer. Just like in silver, what do we want to see? We want to see a follow through next week of the market making a new high. That should trigger buys, and it should trigger buys back into the 34.20 resistance, which we'll take a look at on the smaller timeframes. When we jump onto the daily, what are we seeing? Well, we're seeing two exponential moving averages at pretty key points around this 33.45 and 33.22. 33.22 is a key one. Previous resistance where the market sold off will also be the exponential moving average here on the daily on the S&P 500. So the market structure could be pointing at this acting as resistance potentially on the Monday, and then maybe further selling off if we are to see bearish movement. It really is a critical area in the markets right now. When we go down to the 4-hour, the structure becomes even more defined. Let's put the horizontal line on this area right now and talk about it together. So the 33.20 zone, we've got now on the 4-hour, it's going to be around a 20 exponential moving average. We know that this was respected all the way through the buying up. So we know that this 20 exponential moving average should act as dynamic resistance. We know that it hasn't really been tapped in a while in terms of the real market. It was hit here in terms of between the 14th and the 21st of September. And then during the next sell-off, it didn't quite come up and hit the real market 20. This time would be the first touch, so it needs to find resistance here for the bears to find control. We basically do not want to see a close above this point, because what would that be saying? It'd be saying double bottom on the market. Effectively, we'd be having two lows, one slightly lower low here, but overall bullish aggressive moves off it. And this is all coming off that 3,200-ish area that we expected bullish momentum from Wall Street. So we break through that. What's the signal telling us? Well, at that point, it's saying straight away, we should be moving this distance up, which is the distance from the lows to the highs. We extrapolate that out, and it's getting very close to that 3,400 resistance. We've spoken about any break above 34.20 in the future not only points to probably new highs, but it points to new all-time highs. And this comes from just really looking and understanding market structure. There's always key points in the market that when they're broken, I wouldn't even expect that much resistance from previous high over here. I'd expect if it gets up here, breaks through, then that break on the pullback to actually make even all-time highs. And this area here, not to act as much of resistance as you think. It's kind of like what happened over here during the June into July period. We did find some resistance here, at least initially, but when it cracked that high, onwards and upwards to euphoric points. And we know that when the market makes new all-time highs, usually over the next 12 months, we have an 8 to 9% increase in the market. So we're not even close to that right now. And although we're in volatile times, it still is remaining to be very optimistic on the markets over the longer term. And you should always be mostly a perma bull when it comes to markets. They are inherently buy kind of mechanisms. US 100, very similar to, of course, what we were seeing on the S&P 500. We've got resistance tests here. It did not go as low as we'd hoped. We would have hoped 10,400. Time will still tell whether the market can sell and reverse next week. But big bullish buying aggression into the close on Friday has this market looking relatively bullish right now. But the price action is always key, and we have not broken past this previous 11,200 area. We need to see a close above that, and if we do have that, it's pretty much simplifying that we've got some form of low bottom in here, and we would probably see further bullish aggression back into these 11.6 areas. So next week is really about the 11.2 zone. 11.2 zone break would trigger into 11.6. And an 11.6 break would trigger into, of course, all-time highs similar to the S&P 500. So very, very similarly, we want to be setting alerts for new lows formed on the Nasdaq. If we get under the 10.7 zone, we expect it to go to at least 10.4. If we get above the 11.2 zone, technically we expect it to go back into around that 11.6 area, and for that to be kind of the area that we find resistance and selling pressure. I think a lot of this will come down to debates and just whatever Wall Street feels like they want to do. A lot of it also comes down to put-call ratios. As we saw last week, put-call ratios were generally increasing. We had a 1.56 reading on the S&P 500 put-call ratios for September 25th. Not really super highs. It was pretty much like a bunch of calls coming back in. Wall Street has liked taking money from, of course, us, the retail traders, during this crisis, with huge bearish puts being put on back in May and April, getting completely destroyed. And then, of course, now all the buy calls before this recent pullback getting completely destroyed. So we know Wall Street's really pushing the markets both ways and taking advantage of retail trader sentiment. Onto the calendars, if we take a look for the next week, really there's a whole bunch of stuff going on with election news, but then at the end of the week, there'll be non-farm payrolls, of course, unemployment rate, all of those types of things. We will be streaming that live on this channel, so make sure you check out that event. It's going to be great. We're improving the stream all the time, and we've got so many people coming. It's excellent. And of course, if you wanted to, you can also use the Market Watch economic calendar. And this is mostly to do with US news. So you can see all the US news coming out next week, including, of course, non-farm payrolls, which is expected to be this number. As always, if you've enjoyed this video, please remember to subscribe and hit that bell. And we'll see you next week with plenty of content, plenty of live streams, and hopefully plenty of volatility for you to take advantage of in the markets. Have a safe week. We'll see you soon. Bye for now.